2022 and the market in terms of property is hot. Property prices are going sky high and rocketing. It's just crazy with the whole conversation chat around inflation, looking like before the end of 2022, we're going to be over 10%. Now, what does that mean for property prices? And are we in an impending property market crash with so much overpriced properties and affordability becoming an issue as well? And with inflation adding to all of this mix, interest rates starting to rise as well, then how can we navigate through all the chaos that's happening right now? Well, if you think about it, it's actually quite easy to predict what the next step should be and whether you should be buying property right now or you should be waiting for a property market crash. Well, let's have a little chat around the 18-year property cycle. Now, what I love about the 18-year property cycle is that if you look over the last 200 plus years, it's pretty much played out relatively accurately over every 18 years where we've seen various recessions that have then impacted the property market. So if you look over the last 100 years, which is more relevant, you could say, in the 1950s, where we had a big recession and property market crash, then in the mid-70s, and then in the late 80s, get into early 1990, and then the last one that most people are familiar with is in 2008. So when you look at that and you go back of those last four crashes alone, it's kind of 18-year cycles. And Fred Harrison, who created this here, he's an economist himself, and he had looked through over 200 years of data and then predicted the 2008 property market crash 10 years before it actually happened, because he then showed with evidence the whole 18-year cycle. So what is the 18-year property cycle and why is it relevant in order for us to best navigate through everything that's happening? And based on the 18-year cycle, where are we in the 18-year cycle? This is incredibly important because what I always talk about for those that come along to our events to learn about getting started in property and how to invest right and should we be buying and flipping and what's the right strategies depending on the marketplace. Like, I get all of this and it's a bit of hesitancy then in terms of should we get started right now or wait? Well, what's playing out right now is exactly what should be playing out based on where we are in the cycle. So this might surprise you once we go through the whole 18-year cycle where we're at, because again, are we on the edge of falling off a cliff and property prices just dropping overnight? Well, you're going to realise that that just doesn't happen. Property is not as volatile as stocks and shares or the crypto market, where a tweet from somebody or something that happens in the news will just shock a share price or the crypto price and it just takes a dive. Now, I'm all for diversifying and investing in alternative assets such as stocks and shares and crypto. I have my own portfolio across those as well. However, anytime I invest there, I invest with money that I'm prepared to do two things: lose or hold for a long period of time. I'm not a day trader as such, and nor do I ever want to, because it's just incredibly volatile and I like to sleep at night, all right? So with that in mind, one solid investment is property, because again, if you buy right in the first place, you can't go wrong. And that there is the fundamentals. You know, based on the market being hot, property prices going sky high and rocketing, well, as an intelligent investor, you're not overpaying for property. You want to be paying at the right price, you want to be adding value, having core fundamentals to ensure you've got cash flow, you're able to recycle and pull your investment out, which means you've got nothing at risk, so it doesn't matter what the market does. So fundamentals is incredibly important. But this whole video here I'm going to be talking about is more about the 18-year cycle, how you can understand it, where are we at with that, and how can you navigate through it. So the 18-year property cycle has four different phases. The first phase that kicks off the whole cycle is the recovery phase, which basically comes after a recession. But in this part of the 18-year cycle, it all starts with the recovery. So you've got around about 6 to 7 years of the recovery phase, which we're going to get into. And then we have the mid-cycle dip, which lasts around 1 to 2 years. And once we come out of the mid-cycle dip, then we go into the explosive phase, which will last again 6 to 7 years, before the inevitable happens, where we go into the last of the four phases, which is the recession phase. And the recession phase normally lasts anywhere between 3, 4, or 5 years. Now, even though we go through the 18-year property cycle, understand, and even though we've got history repeating itself over the last 100 years, where accurately every 18 years you've seen this phase play itself out and go into a recession every 18 years. Now, even though we look at this here, what I don't want you to get caught up with is the timelines. Because based on what we're going through here, you're going to really start to see clearly where we're at in that phase, which might contradict things like, we can't be, it's not possible. We're here, surely the next phase is about to come, which we're all aware of, which is the recession phase. But is that going to happen imminently in 2022? Well, Fred Harrison, his whole 18-year cycle, if it was to play out identically to what it has the last 4 times, then we're not going to be in a recession phase until 2025/2026. So where are we right now in the sense of that? Well, that means we've still got 4 years of growth. That's hard for many people to even comprehend and understand. Now, the key here to this video is to understand each of the phases and not to get caught up, because we could go into a recession much sooner than 4 years. It could be longer. And we'll talk about what changes, whether it's going to be sooner or later, and how is the impact of COVID and everything's happening with the war between Russia and Ukraine, how has that impacted the cycle? Has that accelerated things? Has it made things delay in terms of what point we're going to go into recession? Let's unpack all of that. And what you're going to realise, the key thing here is not just try and get caught up in the timing, it's just to understand each of the phases, what strategies you should be applying during those phases, and more importantly, it allows you to navigate to make sure you're making intelligent investment decisions to make money. Because doing nothing is not an option. Doing nothing is not a good strategy, right? You've got to be doing something in order to be making money. That's what it's all about. And one thing I always say is that you don't have a property business if it's cycle dependent. You need to know which strategies to apply when it's during the recovery phase, the mid-cycle dip, the explosive phase, as well as the recession phase as well. And for everyone out there, it says, wait to buy property when the market crashes. Again, it means that you're hoping that something's going to happen and you think that a crash means that property prices are going to drop overnight. So even though we might not go into a property crash in the recession phase until 2025, hey, it might be sooner. And then we know it's a 4-year phase being in that recession phase where property prices start to gradually go down in value. And then that leads us to the recovery phase here. And during the recovery phase, this is where people are sitting there watching and going, should we invest in property? And understand, if you're that person who's waiting to buy property, I will guarantee you, you'll still be waiting in 5, 6, 7 years after the recession, because you won't have the confidence to go ahead, because you haven't learned the skill sets of investing in property and understanding the phases and how to operate and navigate through all 4 phases, not just through a recessionary phase. Because if you're going into a recession, that's where lending becomes a lot more difficult. That's where it's, the criteria to get access to lending becomes a lot more strict. Like property prices are starting to go down in decline, but more importantly during the recession phase is that you've got businesses failing, the stocks and shares market is taking a massive hit as well, unemployment becomes rife, so you've got all of that to look forward to. And if you're wanting to wait till you then go and start building a portfolio when it hits the recession, you're going to realise it becomes more difficult, because lenders are only going to lend to those who have got a track record, who have been seen to being able to build a property business during the explosive phase. So be mindful of that. So let's look at each of the phases in its own right and then understand each of them, because that's what's key about this video, is to understand the phases so you can navigate through all of that. So the first phase being the recovery phase. So what happens during that? Well, that's where the intelligent investor, smart money starts to come into the market. They don't know whether it's the bottom, and that's one thing you need to understand about the cycle, is that you'll never be able to predict the bottom or predict the time when it's going to be at all-time highs. You're just never going to be able to predict that. So all you need to be aware of is during the recovery phase, which lasts a good 7 years, that follows the recessionary phase, which was 4 years. So understand this has been a long process where investors, smart money, are starting to get in to buy, because they know that property prices over long term are always going to go up in value. And they also know that there's less competition, there's less challenges to get deals, and more importantly, there's a lot more stock on the property market. So it means they've got an option to be selective. They can go in and buy properties significantly below market value. No one else is buying. Less competition means that they can clean up and build a bigger property portfolio. But again, for those that are sitting here, and I can't stress this enough, you're going to wait to buy property. I will guarantee you that you do not get started. Because just like most investors, the smart money who's getting involved during the recovery phase, they don't know whether they should be getting involved or not. They just have an inclination based on their knowledge and understanding about investing that this is a good price to buy. Because one thing that doesn't go down over the 18-year property cycle is rent. That just continues to go up, which means when we're during the recovery phase, when properties are at low prices, then it means higher yields, more cash flow. So it just means intelligent investors start to then build a portfolio with no foresight of whether the market's still going to go down or whether it's going to go up. They're looking more long term and it can't go wrong. So during the recovery phase, lending is a lot more difficult. You know, it's again, when people are starting to invest, a lot of people are doubting and thinking, should you even be doing that? But what you're going to realize right before the mid-cycle dip, probably halfway through the 7 years of the recovery phase, you're going to see big institutions starting to build a portfolio and acquire big portfolios. You're going to start seeing, you know, pension funds coming in and buying up assets and property as well. You're going to start to see that, which is a good indicator that the recovery phase is well on its way, and you're starting to see property prices now starting to rise. Now, it's not got the sharp rises we're seeing right now through 2022 because we're in an explosive phase, but property prices are gradually going up. And this is then it's starting to see the foresight of we're coming out of a recession, lending starting to become a little bit more accessible, criteria still a little bit more strict, but much easier than it was during the recessionary phase. And because of this, as things start to really motor on and more people are getting involved, then we start seeing the mid-cycle phase. And during the mid-cycle phase, that there is where it starts to frighten off a lot of people because are we going back into a recession? Because there's a slight dip and a downturn for at least a couple of years. And why? It's because a lot of that smart money are starting to take profits. They're starting to sell some assets. They're starting to release some of the funds that they've got as well. And again, because of that, because they've been through a long recession and a recovery phase, they want to make some profits, they want to take some money. And that there gives a little mid-cycle dip. Now, if we look at the 18-year property cycle from 2008, where was the last property crash, and we look at where we are just now, you could look at the mid-property cycle and go, well, when was that during this 18-year cycle? Well, that was during all the conversation in the chat with the narrative around Brexit. So if you think about it, Brexit lasted a few years to figure itself out whether we're going to exit Europe or not. And that there was what then had more people doubting about property. Are property prices still going to go up? Is it going to be affected? So you could say the mid-cycle with that narrative of Brexit was the perfect 1 or 2 years, lasted more than 2 years, which was perfect for us to look at a narrative that ties into the mid-cycle dip. And then shortly after that, we then into the explosive phase because what happened when Brexit was announced we're going to exit Europe? Nothing happened, yet everybody prior to that was freaking out, panicking, not wanting to buy, thought property prices were going to drop, they're just going losing their mind. And this is why you can't get caught up in the mainstream media, because the mainstream media will just feed you whatever they want you to be obsessed with, to take on board. And you need to understand that smart money, intelligent money, investors are doing the exact opposite. They're manipulating the media to give the narrative to us retail investors so that we then follow suit and don't buy, which means what? They can go in and then leverage the mid-cycle dip to buy more assets and then get at better prices. And understand when the explosive year starts to kick off, which we're well and truly into right now in 2022, this is where a whole bunch of things start to happen. Lending becomes a lot more easier to access, criteria gets relaxed as well. A lot of housing incentives start to come in as well, which we've been seeing, where you've got stamp duty that's been waived for over a period of time. You've got first-time buyer, initiatives to help them get on the ladder as well. You've got all of this stuff going on. It's crazy. Stamp duty holidays, that's the word that I was trying to remember there. And that gets extended over a period of time, which again just forces up property prices because lending becomes a lot more easy to access. And during the explosive phase, right at the beginning of it, because the lenders are coming back into the marketplace, this is where your big house builders now start to look at and go, this is a good time to enter into the market. They've been land banking over the last decade beforehand, waiting for the explosive years where funders are more you know, they're more advantageous in the sense of going ahead with developers and funding new projects. And it's through the construction phase where you can look around in cities where you're just seeing cranes everywhere, development starting to happen, buildings are starting to happen, and with the explosive phase really kicking off, it normally starts with the main economic hubs such as London and Manchester, like key city centres, Glasgow, Edinburgh. When you start to see those getting cranes thrown up and more development, then you can really start to see that we're in the construction and building phase of the explosive phase of the cycle, which again is great news for everyone involved. This is where everyone thinks property prices are going to keep on going up, and then every time you start seeing a narrative of property prices can't go any higher, we're in a bubble, the property market's going to crash, they can't go higher, guess what happens during the explosive phase? You have another year of property prices continue to go up. And this is a crazy thing. During the explosive phase, every time that property prices keep on going up, because it happens relatively quickly, you're talking about 10-15% increases every year on property prices. This is what freaks everybody out. The conversation keeps on going. It can't go any higher. It just can't. But it keeps on going higher, and it keeps on going higher. Even right now in 2022, what's the narrative? Inflation, guess what? As inflation goes up, that also pushes property prices up as well. So we've still got more growth. We could be in a full-blown recession in terms of the recession being caused through business failure, the economy contracting, which has happened over the back of COVID, what's happening with the war of Ukraine and Russia. That has contracted the economy. When you increase interest rates to try and combat inflation, increasing interest rates, what does that do? That then tries to have the economy contract and not spend. And if you're not spending, that contracts the economy, so it means you could have a couple of quarters of negative growth, which puts us into recession. But the thing that governs property prices, which is so vitally important to allow you to navigate through each of the phases, is to understand that it's all down to supply and demand. 2008's recession, what happened when we went into recession and a housing market crash, the financial crash? The property market was already awash with lots more properties. We don't have that scenario right now. We live in the UK, we've got a massive housing shortage. Not enough properties are being built every year. We're talking about 300,000 new homes are supposed to be built every single year, and we're getting nowhere near hitting that number. Massive housing shortage, which is driving up property prices, inflation further driving up property prices, and hey, people are buying, paying over market value because of many different reasons. And what's just come out in June 2022, you've now got the Bank of England coming out and saying they're going to relax and take away all affordability criteria when it comes to lending. Do you realise how freaking crazy that is? It's nuts. You know, if you look at the average UK salary, it's 32,000. If you take London out of that, you're talking it's a lot less. You're probably into 27,000, 28,000 as the average UK salary. And what's inflation doing? As that goes up, wages are not matching inflation. So when you take all that into consideration, it's just crazy to think that if you take 32,000 as the average UK salary, the average house price in the UK is 255,000. That's 8 times the average UK salary in terms of the affordability. And in the Bank of England, they're going to take out the affordability test. Is in terms of your wage, and you can get a higher mortgage if you choose to. It doesn't matter if you can have, like, do you realise how crazy this is? And that's kind of the signs of happened before 2008, where you had subprime mortgages, self-certified mortgages, 120% loan to value mortgages, all this crazy stuff. During the explosive phase, this stuff tends to come back into the market because history repeats itself, and we've not yet saw that, even though we've got all of this chaos that's going on just now. So, what then transitions from the explosive phase into the recessionary phase? Because again, you've got to look at indicators, supply and demand being one. So, through stocks and shares contracting, businesses starting to fail, banks failing like the things that happened in pre-2008, understand that Lehman Brothers closing the doors in September 2008 shook the market, but businesses were failing prior to that. Right now, we've got unemployment at an all-time low. There's over 1.3 million jobs available right now in the UK, and we have got less than 1.3 million in terms of people who are unemployed. Like, it's crazy how there's more jobs available than there are unemployment. It's just crazy to think. That's never been like that for a long time, like over 40 years. So with that in mind, we've still got a lot more growth in the economy. The government are continuing to feed that growth. Inflation's a great thing for property prices, and inflation, we need to combat that because that affects the cost of living for people, especially those that their salaries are not increasing in the rate of inflation. And that's why interest rates increasing to what now? It's 1% over the Bank of England base rate. It's forecasted to go over 2%. Who cares? That's still incredibly low, cheap borrowing. People are getting caught up in a few percent. I mean, think about it, in the 1970s, during the Maggie Thatcher days, interest rates were over 17%. And people were still buying property. It's just crazy to see. Funny enough, if you go back to 2008, before that was the last 18-year cycle during that kind of period of time. So is inflation going to spiral out of control? Is interest rates going to go as well? Well, think about it. It's all about supply and demand. And we need to be aware and watch that. When businesses start to fail, people start to lose their jobs, unemployment starts to become rife through the marketplace. This is the early indicator of we're getting into a recessionary phase, and through all of that that's where people are then forced to have to sell their property, more stock comes onto the market, and this doesn't all happen overnight. This takes a longer period of time, and because that longer period of time plays out, that's why a recessionary period is over 4 years, and then the recovery that precedes it is like 7 years as well. So be mindful of where we are. We're probably only halfway through the explosive phase, which is hard to even believe in 2022. Forecasted if the 18-year cycle plays it out accurately, it's not going to happen until 2025, 2026. Don't get caught up in the date. Could it happen sooner? Could it happen later? Yes. We just need to observe and watch. But a strategy is to wait to buy property is just the wrong strategy because you'll be waiting for many years. It's about being an intelligent investor, buying right regardless to what phase we're going through. And arguably, if you're able to find the right property deals, off-market marketing, which the pros do, then you're able to buy and flip. Benefit from the increase in property prices, developing and selling properties and making fortunes, flipping property deals, trading on deals for great cash flow, building a portfolio which has got a mix of buy-to-let, service accommodation and HMO with strong cash flow that doesn't matter. But if we're doing intelligent investing, buying right, adding value, refinancing and pulling the money out, then what have we got at risk? Nothing. If you're an intelligent investor through the 18-year cycle, you're always making money through every single phase. And with that in mind, nothing should fear you. You should embrace it, and then you're able to navigate through all of this. So, what's your thoughts on the 18-year cycle? Do you believe we're halfway through the explosive phase, or do you believe that we're now tipping and about to go into a recession? I get it. It feels like that. It's given that sense that we are, but there's still a lot more to play out. You know, I own a mortgage company. We write a lot of business, and the lenders that we work with various people, like hundreds of people on a monthly basis, get mortgages. Lenders are actively lending, relaxing their criteria still, which is only going to force property prices to continue going up over the next few years, regardless of what the mainstream narrative is saying. My experience with everything is whatever the mainstream media are telling you, do the exact opposite, all right? So with that in mind, I'd love to hear your comments. I'd love to hear your questions as well. Just comment below and I'll answer those as well. So all the best and bye for now.